Sure. Whenever you're ready, Mark.
Go ahead and go for it.
Okay. Good evening, everybody, and welcome to the Manifest Better Investing Roundtable. This is our March edition, our COVID-19 edition. Most of us are sheltering at home this evening, but that's not very different from the way we normally do a roundtable. Most of us come to you from our homes on a monthly basis, and we've been doing this for over 10 years. I'd like to introduce to you my good friend Mark Robertson, and he'll be speaking to you as your host for this evening. So Mark, it's yours to take away.
All right, well, greetings everybody. And we are joined here tonight by Kim. Kim is the rose that's leading 4 thorns on the cover page. And all 5 of those thorns basically have one mission in mind tonight, and that's just to share some thoughts, share some lessons that we've learned over the decades. And this entire program, like Ken said, has now been on a monthly basis going up on 10 years. And it really is an effort just to share some ideas about the broad realm of investing, and then share a few ideas and actually walk through those ideas using the method that has been taught for decades, nearly 8 decades now, guys, with the Modern Investment Club movement, and do some demonstrations, some analysis, and that type of thing. So that's what we would like to do in the spirit of this. We're not going to spend a whole lot of time tonight talking about what's going on with the market. We're going to take a look at a couple of quick snapshots and just some thoughts from 35,000 feet. Ken Kabula and I will be giving a program next Monday where I expect we'll spend a little bit more time, a little bit deeper into the details of what's going on with the stock market. But with that, welcome Kim and Cy and Hugh, and thank you for being here and sharing with the audience.
Mark, I think that program that we're going to do is next Tuesday.
Well, I looked, and it's actually out on the internet as the 6th, which is Monday, so we'll talk about that.
Okay.
We'll figure it out. I thought it was Tuesday night too, but it's showing up as Monday. All right, just
okay. Thank you.
Legalese, no investment recommendation is intended whatsoever. This is about education and demonstration. As I said, it's about illustrating and just demonstrating the methods that are used by investors who follow this time-honored methodology. Just a reminder that we may be actually talking about stocks that are in our portfolios. If you'd like to, if you have a family member or friend who you'd like to include on the email reminder list, please send an email to nkavola1@comcast.net. If you have a follow-up question, we're probably not going to have a lot of time for Q&A because we have a bunch of slides and things to share with you tonight, but we try to leave some at the end. But if there's overflow, or if you'd like a copy of the slides, please send me an email, mark@manifestinvesting.com. And since I'm sheltered at home, I'm catching up on my email. All right, our standing agenda, again, coming up on our 10th anniversary here pretty soon, pretty much the same. Welcome, everybody, but especially big welcome to any newcomers that might be in the audience. We do tend to keep it fairly informal, and we do take questions along the way, and Ken is our sergeant at arms, and he keeps us on track. But again, welcome, especially if you're a newcomer. We're going to spend a few minutes talking about our perspective on the recession and how it matters and what it does to us as investors. We'll talk a little bit about the performance results, talk a little bit about the portfolio. We don't have any pure challenges to the portfolio tonight other than a big challenge that we'll talk about how stock market's just gone kind of haywire. You see the 5 stock presentations from the damsel and her 4 knights. We do have a poll at the end, and we will try to leave some time for discussion and Q&A.
Mark, I'm going to squeeze in here. We have 2 hands in the air, and they went up pretty quickly. So
Sure.
Let's see if we can get those questions answered. The first hand was from Terry Henley. And Terry, go ahead. You're unmuted. Terry, you're unmuted. Go ahead. Okay, that was an inadvertent hand. The other hand is from Ray Pickles. Ray, I cannot unmute you because you're self-muted on your end. So Yep, I can't unmute you, Ray, so we can't get your question answered. So go ahead, Mark, okay?
Okay. Speaking of challenges of technology, that's the type of thing that you see often in podcasts or this type of thing. Here's just a quick introduction and a reminder about what this is about. We meet generally on the last Tuesday of every month at this time, and we do try to air out a single or one of our, from a short list of favorite actionable investment opportunities. Actionable does not mean dial your broker. Actionable means study, do your homework. We do welcome non-core selections. Non-core selections are defined as special situations, early stage investing, turnaround situations. Hugh's going to bring us one of those tonight for sure. The goal is to build a portfolio overall. You don't really look at the results of any single stock that's nominated or decision made. You look at the aggregate results. We'd like to see those collective results beat the market as measured by the Wilshire 5000 by 5 percentage points over the long term. And we would like to see the majority of our recommendations outperform the stock market from the time of selection. I just want to I'm going to take just a couple of minutes here and just capture the gravity of the moment that we're in. What you're looking at here is the value line arithmetic average, and the blue is just the trend line for that. And the red is the value line median appreciation projection. That's a really twisted way of just simply saying, what if you took and did a stock selection guide using every page in the value line book and basically came up with an average? Now they come up with a median, but basically the average stock study using the value line assumptions, and then you averaged them all together. And that's where you get the red line. So again, stock prices fluctuate, so do return forecasts, so the expected returns. And you can see that, again, going back over the last 20 years or so, we had that nasty moment in 2008, 2009 when the stock prices went down. You can see that with the white space here in the middle of the graph. And the return forecasts, again, thinking back to that time frame, it was gruesome. In terms of elevated expected returns, elevated pars, the upside downside ratios in the 20s and 30s, and it was really kind of tough to think about what might be on the other side of that chasm. That's the way we talked about it back then. How deep is this chasm and where's the other side? And that was a pretty interesting moment in stock market history. Well, lo and behold, this last month, and it's never been more sudden or more ferocious. We're basically back where we were in terms of the average, stock study result. It's really unbelievable that could happen that fast. And I think this actually speaks to the nature of the moment that we're in. Any thoughts on that, Ken, or anybody else?
I do have some questions from the audience, Mark. Let me try to get them to speak and see what happens. Bruce Buxton. Bruce, you're unmuted. Go ahead.
Hey, Bruce.
Another inadvertent hand. Jaya Nakin. Jaya, you're unmuted. Jaya, I cannot unmute you. You're self-muted, so you'll have to unmute yourself.
Looks like we've got more newcomers than usual.
Jaya, you're unmuted now. Go ahead.
How do you determine what's core and non-core? What criteria you use for that, please? Thank you.
I think we can probably a bit more detail, but I'll just give you the 5-second answer. Core would be a very high quality company with an established track record. Non-core would be, again, like I said, a special situation, a turnaround, early stage investing, company that might not have earnings, that type of thing. So we basically distinguish between the two that way. It's in the eye of the beholder. So it really comes down to that. Okay, here's a look.
The terminology is a bit outdated, but if you've been investing long enough, and again, this is a little bit oversimplification, but core would be blue chip-ish.
Absolutely.
And non-core would be non-blue chip type stocks.
Yeah. Something that you were happy to hold for 5, 10, 15 years, probably.
Absolutely. Like sometimes we think in terms of blue chips and red chips. All right, so again, same information, a little bit different thing to look at. The Wilshire 5000 has taken an equally nasty dive, and the median projected return, my par, at Manifest is actually, it climbed up to a high of 18. It's actually around 14 tonight. So again, just shows the extreme nature of the excursion that we've been on. You can see that back a year ago in December 2018, we had that really nasty month or nasty quarter at the end of 2018, and that produced that second highest bump on the right-hand side of the chart. So we're in a pretty tough spot. So what I'd like to do is just spend just a quick moment going over, how we look at the recession question. And what I've done is basically gone in and taken the value line collection of companies, stripped out all the banks and insurance companies, the asset-based businesses, so that we could focus in on the 1,400 industrial companies in the value line book. And basically taken and stacked up all of their net margins, their actual net margins over a period of, as you can see, nearly 20 years there, just to take a look at the median profitability as measured by the percent net margin over time. And what you can see, in the middle of that graph, when we got into the 2008-2009 recession, what actually happens to us is our stock studies fall apart because many companies, basically dive down and go into negative earnings. It really messes up our stock selection guides. So again, the weaker companies will go out of business. It's important to have higher quality companies in that situation. But you can see that during a recession, that median profitability dropped down in that 6% range. Now notice over here, we had a couple kind of lackluster years that didn't feel so good. And then notice that for 2019, we were in kind of the 8%, 9% for 2020, 8, 9, 10% type zone. And this was towards the end of 2019. And everything was kind of going along swimmingly. I would argue that we were doing quite a bit at the federal level to bolster that stuff. Buybacks are in progress. All that kind of stuff was bolstering. But that all began to unravel in the fourth quarter of last year, in the first early days of this year. Basically, we dropped in the first couple months of this year. The actual results for 2019 actually dipped down here and actually began tiptoeing sort of towards this recessionary level that you see over here. 2020 actually dropped down also, and as of March 12th, 2020, this is the picture that was beginning to develop. It just continues to get worse. 5 days later, the numbers, down here at 7, and here's your 2020 estimates, again dropping down and approaching 8%. I mean, we're only talking about a matter of a few days, and I'm going to toggle back and forth between these next two. I also want you to notice that we dropped off the 11%, and actually there's a scale change here also. But notice that as March 23rd hit, again, the 2019 numbers were hanging out down here around 7, not the 8 or 9% that had been expected. And the forecasts for 2020 and 2021 are beginning to compress or move down. This is just a week ago. Fast forward again, just 1 week. This is, again, all of the analysts checking in with their estimates. And I want you to notice that those are all still compressing. I'm going to toggle back and forth so you can see the change. There's a week ago, and here's the current numbers. And trust me, as of tonight, with the analysts turning in their homework assignments, these are continuing to compress down. So what does that do? Basically, every section 2A on a stock selection guide is compressing down on the right-hand side. As much as 10% is being taken away from the profitability of companies. Companies that were projected to come in at 9 are now projected to come in at 8. And just think about what that does. Your homework assignment is go home and look at a couple preferred procedures and make that adjustment and look what happens to your return forecast. So that is literally, again, one more time, this is just a week. And we're watching these on a weekly basis at Manifest. They are compressing, and that's what we're watching very closely. We are concerned and hope that we do not see that type of formation happening here with what's going on with the Wuhan virus.
Two observations before you go on, Mark. First of all, the 2019 actually went up between March 23rd and the 30th by about by about 2.5 percentage points. I assume because the actuals are coming in higher than the 23rd's estimates were, because and that leads to my second observation. Remember, 2019 for virtually every company covered by Value Line closed their fiscal year before the coronavirus hit big time in the United States. Now that doesn't mean that the earnings have not been or have been reported, because they haven't. We're still in the matter of getting them reported. That's why the estimate's bouncing around, because it's not actual. But the point I'm trying to make, that big drop that you saw, I guess, from your scale, probably from about 8.5 down to 7 and 7.2 or so in 2019 is not COVID related.
It's not. It was before that. Yeah,
right.
Right.
So kind of what I'm saying is the perceived health of the economy may actually have been lower than it was pre-COVID, and then of course now we've got all the COVID challenges.
You're exactly right, and we're about 2/3 of the way into the actual results for 2019, and that's exactly what you're seeing. So yeah, just something to keep in mind. So we will be watching the impact of the COVID situation on this also. I don't think it's going to be pleasant, but I better plug in, or you're going to lose me. I'm going to have to take just a short break. I'll be right back. Ken, why don't you go ahead and cover this?
Okay, this is our standing graph. Our goals are in that dark blue box right up at the top of the screen there. And we'd like to see our investments that we make and that we track, we'd like to see them outperform the market by 5 points. You've heard that from us for years now. We think that matches real closely when George Nicholson said that an investment club should aim at 15%. Now that was about 5 points ahead of the average market, and 15% is still about 5 points ahead of the average market. That red line signifies the plus 5%, and you can see the 0 down near the bottom there. Here we're tracking our portfolio from our third year, 10th year right now, and the most recent results show our compounded rate of return annualized at just under 15%, 14.6%. When you match that to the Wilshire 5000, if you had put the same money in an index fund tracking the Wilshire 5000, you would have returned a compounded 7%. So our relative return is the difference between those two numbers, 14.6 minus the 7, which gives us a relative return of 7.6, which puts us 2.6% above our goal. Our outperformance accuracy, what that means is we'd like about half the picks we make to outperform the whole market. And right now we have about 46% of our picks outperforming the entire market. So our goal is, we're very close to what we set as our goal 10 years ago. And I think that when you would ask anybody, could you give me a 10-year investment that returns 15% a year? I think they'd be hard-pressed to find one that's as relatively safe and as relatively easy to put together as ours has been. Now, I don't want anybody to get the idea that a personal portfolio should hold as many stocks as the tracking portfolio that the roundtable holds, but the concepts are all the same. The way we choose stocks are all the same. And we go into quite a bit of detail when we're ready to move a stock out of the portfolio. We explain why we're doing it. And we do this all in real time with our sleeves rolled up. So if a bunch of fairly bright amateurs can make this happen, then we're reasonably certain that we can transmit that information to other people in our community and they can make it happen as well.
All right, I had to step away.
Mark,
Just
are you back, Mark?
I am back. Can you hear me?
We can hear you just fine,
All right, I'm back on real power now, not just battery.
Okay, and Mark, while we have a break here, I'm going to unmute Lynn Pfister for a question, okay?
Absolutely.
Lynn, I can't unmute you because there we go. So go ahead, Lynn. Well, Lynn, you evidently have your mic turned off. We can't hear you. Why don't you communicate your question in the chat box and I'll bring it to Mark's attention then, Lynn. I'm going to put you back on mute. Okay, Mark, continue.
Okay,
thank you.
One last thought that just kind of grabbed me because I watch this not just once a month, but it's on a screen that I can see almost daily. We actually had a point during some of the worst downward trend in the stock market where this relative return was like 9.5%, almost 10%. And what that says is our stocks were basically outperforming on the way down with this avalanche is going on. I just think that's so cool. I mean, it's at an all-time high now, but we tend to see that with many of the type of portfolios that our community actually engage in. So that was kind of fun to watch. I was kind of hoping that we would, be at 10 plus, and I'd have to actually change the graph, but we can keep hoping. All right, moving on. Just we got to roll because we have a bunch of stocks to go through here tonight. Also,
okay. Mark, I have one germane question that you can handle real quickly. Mark Nervig wants to know, why do we choose the Wilshire 5000 as the benchmark for comparison?
Well, they all kind of do tend to run together over the long term. We just like the fact that the Wilshire 5000 is a little bit broader. It's just something we like to keep track against. You could use the S&P 500. That's good for longer term comparisons too, but keep in mind that is really focused on just large companies. So when we're looking at the Wilshire 5000, we're really trying to measure against kind of a form of all of the above investing that includes medium and small companies in it. That's the real driver behind it. And yeah, I'm fully aware that it's cap weighted and behaves like the S&P 500, but that's the short answer. All right, here's the actual top 20 holdings in the tracking portfolio. Like Ken said, you would probably never have as many stocks as we do in the tracking portfolio. You can see the entire portfolio at the public link in the middle of the page there. So basically what we do with any decision that is made, whether it's a knight or a damsel or the audience voting for a stock, we invest $1,000 into it. So Microsoft, that's how you use the key up here. Microsoft has been nominated 5 times. So $5,000 has been invested into Microsoft. That $5,000 is now worth $35,000. So you can look at that top to bottom. Some of these, by the way, are single time selections. Amazon is a 2-time selection. It's really kind of cool when you get a few years under your belt to watch the numbers take off when they work out well. All right. So some household names and some that are not so much household names on that list. All right. I don't want to spend a lot of time on digging into the portfolio tonight, other than this is going to give, I know it's going to give Cy the heebie-jeebies. The overall return forecast for the portfolio right now is 14.2. That's as of tonight's close. And the median stock is at 14.7. We like to try to stay 5 percentage points ahead of that. And obviously, our stuff has done pretty good. The stocks have done well, therefore the forecasts are down on a relative basis. And again, we are continuously over the long term trying to keep that number in that so-called sweet spot. And we're basically right at the return forecast for the market. I'll been open up for questions in just a minute, but I just want to give my knee-jerk reaction to where we're at. I think the MyPar is a little bit high. And it's high because of the lag, especially in some of the smaller companies. We're getting all the companies in, so they're updated every single day. But as some of these weaker, lower quality companies are updated, especially with the COVID-19 stuff going on right now, I have a feeling that that's going to give us a little bit of a gap here. And I want us to be patient, but I do believe that we should consider some quote unquote spring cleaning over the next month or so and challenge some of these very actively in the next month or two, but not to get overcome by the fact that these two have kind of converged on each other. Take it away, guys.
Heebie-jeebie.
Okay.
No, seriously, that I think that, and I've been raising it for a few months. I'm concerned that the par and for the portfolio compared to my par has been coming much closer than we really would like it to be before this major divergence has occurred. I would also agree with you, however, Mark, that probably the price drops have gotten ahead of the coming expectation drops, which will bring it closer to line. But that said, I think even if 3, 4, 5, 6 months down the road, we're coming closer back to equilibrium in the market, wherever that equilibrium falls, we still need to be looking at our at ratcheting up our portfolio return, particularly by weeding some of the lower return companies, which again, realize if the par is down low, that means one of two things. Either the expectations for the company have fallen drastically, in which case we may have a quality issue, or they have held up very well in this huge downdraft, which may also be take the money and run.
Which is generally what we've seen. I mean, look at Resman.
Yes, exactly. Yes.
Mark, I run 4 real money portfolios, an IRA for me, an IRA for Natalie, a joint taxable account, and an account for our family investment club. And on all 4 of them, I'm very content to keep par for the portfolio 2, 3, 4 points above my par. If I hit the sweet spot, that's great, but the stocks that I put in these holdings that are real money for me tend to be a little bit more conservative than the stocks I would put into my real investment clubs that I belong to, my actual investment clubs that aren't made up of all 70-year-old people. So I've noticed that in a period of about 3.5 weeks, just as the market did all these machinations, so did the par values of my portfolios plunge to my par, or in a couple of days to below my par. So I'm with Cy that I don't want to do it right today, but I do think that we need to perhaps do some serious house cleaning, maybe in 2 months, maybe in 3 months. But when we start to see the economy at its low point, maybe it's time for us to then take some of these returns and put them into, if this were a real money portfolio, we'd be turning that money into stocks with a much higher par. I know that's not the way we do the tracking portfolio, so I'm not as concerned about it for the portfolio's sake, but I would counsel people that are out there that you got to kind of keep an eye on what the whole portfolio is doing. And when the whole portfolio moves down beneath the average, you have to ask yourself if it's time to sell some of the great stocks that you really are in love with, but they're sitting with fairly low returns going forward because they've done so well compared to the market.
Absolutely. And I'll just close with just noticing that Clorox is an example. I mean, Clorox, for those of us that follow it, my goodness. I mean, that actually dipped into negative return forecast territory because it was pushed up so high, and an opportunity to sell just kind of screamed at us there for a few days. And I think we have to be ready for that. And as I was saying, you know, that previous graph looks like it does because so many of these companies have carried the ball so well during this downturn, and that's just flat out. All right, so let's go ahead and close down that part of it. We can come back and talk about that stuff some more. I know we're going to be talking about it a month from now too, but let's go ahead and go through the stock presentation, starting with Alphabet Google. Take it away, Ken.
Okay, this is the stock that I'm choosing to add another holding to tonight. You're all familiar with the name Google. The corporation that it belongs to is Alphabet. They've gone through a significant change in management, but not really as significant as maybe the headlines want to shout. The two founders are still very much involved with the company. They sit on the board, and they've made it clear they're going to stay involved in the day-to-day tinkering, especially with some of the brand new it's not off the books, but it's off the radar kinds of businesses that Google is working with, some of the brand new ideas. Their new CEO actually has been with them for quite a while and has had a chance to prove himself as quite a capable leader. And much of the leadership team has been there for at least the last 3 or 4 years. So you're not looking at a huge sea change as far as leadership, but the names have kind of changed so that you get the sense that there will be a new direction, but I don't think it's going to be a new direction that is drastically different from what Google has done in the past. Slide, Mark. I presented this for consideration in October 2019, and I captured the stock search criteria that I used in October 2019 when I was looking for a stock to bring to the roundtable. At that time, my par was 8.7%, and I did a search, and you can see the criteria I used, looking for companies with par at 13% and 80 or better quality, financial strength, and earnings stability. And I wanted to stay with faster growing companies, so I chose 12 as the bottom limit for sales growth. In March 2020, with my par hovering at 14.6 and the bottom of the sweet spot, therefore at 19.6, I changed my stock search to a par of 18 and left everything else the same. Next slide, Mark. Well, the top is what I got in the search in October. Google was at the top with a par of 17.5%. Pretty decent quality, great earnings stability, fantastic financial strength numbers, and a fairly decent PE for the kind of growth that it was anticipated to be giving me. When I did that same search in March, I got the results in the bottom down there. Par a little bit higher for Google, quality staying pretty much the same, earnings stability moving up just a touch, financial strength moving down 1%, no move at all really, and growth slowing just a touch from 18.6 to 16. Now remember, Google's a huge company, and we should expect it to be growing somewhere around 5 to 7%. So this huge company growing at either 18 or 16% is something that bears looking into, and I certainly decided to take a look into it. By the way, the other two companies that came up on this stock search, One of them is going to be presented tonight. And I almost chose Credit Acceptance as my company this evening. The only thing that left me away from it was the difficulty in explaining its business model. I think Credit Acceptance is an extremely interesting company, but before you just go out and invest in it, I think you have to spend a little bit of time, maybe more than 10 minutes, trying to understand exactly what its business model is. It's quite complicated. So let's focus on Google. Next slide. Here's the value line corners, and these are the two places that I like to look in the beginning. Up in the corner up there, I had noticed that Google had been chosen 5 times for the round table, most recently last October. The holding was worth somewhere around $85,000. And I noticed on the website that the timeliness rating for Google had been raised from a 3 to a 1 on May 5th, 2020. At the time of the current value line, and that's dated February 7th, Google was trading at $1,453. At the end of trading on Monday, it was trading at $1,147. So a considerable discount to where it was, about 2 months ago. But Google still liked this stock, even at $1,453 per share. Capital appreciation for the pull to 2022 to 2024, nicely above the value line median. It says that the shares may appeal to patient accounts. And if nothing else, better investors are patient investors. Next slide. Most of Google's revenue still comes from search, revenue from targeted ads. That's being hit particularly hard right now because many small businesses are not operational. Many large businesses are not operational. And I get the sense that a lot of ad expenditures are being pulled from Google at the moment. I anticipate that the first quarter and the second quarter of this year will have some real negative impact to them, that they'll be something like we've never seen before from Google. But I do anticipate a pretty quick return once things begin to move back to normal. I anticipate that one of the first things that'll happen is companies will be out there advertising, trying to interest you in coming back to their business, whatever their business happens to be. Google does more than half of its business outside the US. And of course, we're all in this together right now. So I anticipate that what's happening in the US is happening elsewhere and vice versa. I like that very boring quality line. That's the blue line on this chronicle right here. The quality on Google has stayed, extremely consistent over a long period of time. And I like the fact that if we buy Google tonight, it's at about an 8 or 10 year high value. That red line is the par value, and that end of that red line is actually the highest point on that red graph across. It's just a little bit higher than it was back in October of 2019, or back one other time when we added it to the portfolio. So I like buying at high points and maximizing the possibility of nice returns. Another click, please. Excuse me.
No coffee.
Well, it was a jelly bean this time though, Mark. It wasn't anything else. So here's the lines on the graph. They're extremely straight. That one anomaly in 2017 is due to the Jobs Training Act, the tax cut, if you will. They had to pay out a portion of their earnings in repatriation taxes. But for the most part, the growth has been extremely consistent for this company. Next slide. I'm showing the numbers for that growth up on top, and I did my SSG based on about 12% sales and about 13% earnings growth. Those are certainly within the realms of any of the sources that I've read. My only problem is that as I read the sources, I keep reminding myself that I'm flying a little bit blind because none of the sources are yet reflecting the COVID-19. This problem came about so quickly that the sources are racing to catch up. I won't get another value line from Google for another month or so yet. So the Morningstar report is over a month old. So when those new reports come out, I'll be watching them very, very carefully. I noticed that in 2019, profit margins slipped back to where they were in 2017. I'm not especially concerned about the trend that's going on there. The return on equity is a nice return on equity. 15 is a good number. High teens is a is a B plus A minus number. If that should hit 20% return on equity, that's an excellent number, but I'm pretty happy with that, and I'm very happy with the relatively low debt that this company carries and has carried for at least the last 10 years. I've struck the 2017 PE values because of that anomaly in the earnings because of the Tax Act. And my averages, therefore, are based on 4 years. I note that the current PE is 23.3. The average was 26.6. In October, when I chose Google, the current PE was 23.6, and the adjusted 5-year was identical to what it is now. Remember that since October, 2014 has left this graph, and 2019 numbers have replaced those numbers. So the replacement of 1 year by a newer year did not change the average at all, and the current PE is within 0.3 of what it was back in October. Next slide, please. There's my results from the October study in the upper left. I used a PE of 30 and 20. I saw no reason to change those values tonight, so I keep the PEs of 30 and 20. You can compare the high price and the low price, and you can see that they're very, very similar to each other. In other words, I don't think Google is looking much different on an SSG than it was back in October when I thought it was a great buy. Next slide. In October, that's the upper corner, the upper left. The total return was about 16% with a par of about 12. The current SSG, the total return about 19% with a par value of 14.5. The upside downside ratio is a little bit higher today. Total return and par values a little bit higher. The current price on the stock is down 11% from where it was in October. Next slide. Here's the manifest sheet showing a par of 18.8. Boy, that's awfully close to the high return that I came up with on my SSG. And the manifest average PE is smack on the average PE that I was using with a high average of 30 and a low average of 20. Next slide. This comes up when I do a search for Google. When I look at the Google sheet, I note that it's the second company in the internet content and information industry, second only to Facebook. I considered Facebook for tonight, and I decided I wouldn't buck the yellow background, although an awful lot of stocks that I really like in this market have an amber background. An amber background just means take a careful look at it because it might be too good to be true. I don't think this Facebook number is so high that it shouldn't maybe have a lot of belief behind it. But again, I stuck with Google. Even in the communications sector, Google is ranked, and it came in third behind Facebook and IPG. So when it's all said and done, I'm going to add another holding in Google. If it was a good buy in October, And if nothing basically has changed except this virus entering our lives, I think it's probably still a good buy today. Everything I say is predicated on the fact, and I truly believe what I'm about to say, that we will beat this virus, whatever it's doing to us as a nation or a world, and that we'll do it relatively soon, that we'll have some medication that will deal with it, and at some point in the next 6 months to 18 months, we'll actually have a vaccine. So with all that, I'm going to add another holding to Google.
Okay, thank you, Ken. And again, one more epidemiologist on the internet tonight. Ken joins the ranks. I think we'll turn over the microphone to a guy who actually works in the industry.
Good. Can you hear me? Well, this is actually fundamentally a math problem, so it's up Ken's alley. It's unfortunately ruthlessly and brutally expressed through biology. But those models, you haven't seen that press briefing today. I'm looking forward to looking at those models later. But they're very accurate in terms of how things are sensitive to various parameters they put in, which is basically wash your hands and keep it apart. Everything else, a little bit of guesswork. But so my name's Hugh, and live in just outside Los Angeles, and I want to run through the thought process that I have for picking a company. My instinct, and it has been like this for years, is to pick something that I've already bought. You can call it lazy if you want, that might be accurate, but frankly, if you've already done the work analyzing a company, why not buy more of it if the price is right? I generally look at sources so that I can find out if the companies are near their 52-week low. Again, laziness. I want the stock to go up, and the lower it is, the better. That's another thing. I didn't really wish that to happen this month, actually. Things have gotten a lot lower than I could have ever anticipated. And if it's new, there must be a compelling reason to buy the company. As I said, I have a predilection for adding something I already own. Of course, there are lots of reasons this month. I buy companies that I would never really look at otherwise. All else being equal, I buy what I bought before. However, this time on the next slide, you'll see that the company I spent a lot of time with, United Airlines, I think it's time to buy it. The stock has been pummeled, as all airline companies have. And my basic thesis here, echoing what Ken just said, is that things will get back to normal, maybe a new normal. But as we've seen from the charts early on, it doesn't really matter what you throw at the US. If it's terrorists crashing into buildings, if it's the banking industry coupled with people writing weird mortgages, bankrupting the country, if it's a world war, if it's a Great Depression, it always bounces back and bounces back with aplomb. And United Airlines, the share price has gone down. And the nice thing about this is the airlines are the ones that go to Congress with their hat in hand for money, and Congress always seems to give it to them. So there's no reason to expect that they won't be able to get at least very low income loans now, or low interest loans, or even cash. Recently, the revenues of its airline, it's obviously a large company, 41 billion. The numbers that appear in parentheses are, in order, American Airlines and then Delta. So it's the big three. I'll talk about Southwest in a minute. You can see that Delta, and we'll show more about this later, looks to be a better company, even looking at the two numbers of revenues and earnings, because Delta has always had better earnings than United, over the last 5 or 6 years. It has a fortress hub in Atlanta, which it exploits to the hilt. The fleet size, 843 aircraft, that's the mainline fleet, the thing that is United Airlines. Then there's 1,380 if you count all the feeder airlines, United Express and similar type things. And again, 945 aircraft for American and 913 for Delta. United serves, based on the size of its fleet, almost more destinations than any other carrier. It serves 342. Yeah, United, much bigger fleet, but it only serves 340. Whereas Delta serves 322. But when it comes to the international network, United really dominates, very close to Delta, but it has 369 international cities versus only 248 for Delta. But Delta's international network is actually a little bit more profitable than it is yet. United's. And finally, these are the passenger numbers. So a lot of people are crammed on airlines. No one likes being on an airline, although a lot of people like to be in first class. So if you can get into first class, that United Airlines loves you. The interesting thing about airlines, by the way, I love looking at the industry, because the fact is that you can carve it into the various, and it has been disaggregated into the various cost components, say catering, maintenance, cleaning up of the aircraft, repatriating your baggage when it gets lost. All of these are done by separate companies. And even when airlines are losing money, all of the ancillary or support companies can be profitable. So it's an interesting niche that airlines have got themselves in. However, they've figured out a way finally that when the economy is doing well, that they can be highly profitable. And relatively speaking, for a capital intensive industry over the last couple of years, they've been extremely profitable. It took them about 70 or 80 years to figure out that airlines don't fly you for free if you go and get a meal. So they decided, well, we should fly people and charge them for a meal. It also took them about 70 or 80 years to realize that some people would like a lower fare and pay separately for their bags if possible. But they got all that straight now, and they have been profitable for the last few years. United is only about 11% of passengers of all domestic carriers. It's number 4 in the nation. Surprisingly, SkyWest follows it with close to 6%. So we skip along to the next slide, southwest, of course, the east here. Obviously, the SARS-CoV-2 virus, COVID, has dominated the news. Load factors have plummeted. Just before we were on the air, as it were, on there, people, I just took a look at some of United's more profitable routes on their award-winning app. Sounds like I work for the company, but I feel I do because I'm in airplanes all the time. At least I used to be. And the fact is that when you look at, say, Los Angeles to Newark, which feeds international flights when they're flying, or San Francisco to Newark, which has normally 14 flights a day, today of those 14, only 4 are actually flying. And from Los Angeles, out of the 10 they normally fly, or 12 they normally fly, only 2 are flying. And even though they're saying that, you know, load factors are 20–25%, load factors on their erstwhile most profitable routes are way down to close to single digits. The planes are empty. And the last time I flew was an international flight from London. Granted, it was the day after the president announced flights. People carrying European passports who are not permanent residents will not be able to enter the US. The flight that I was going to be on almost 3 weeks ago only had about 50 or 60 passengers. That rapidly filled to about 70% over the case of an hour. A couple of weeks before that, when I was over in the UK, the flight was less than half full. So the effect has been going on for at least a month. Airline passengers are down by airline passengers are down by over 75%. Flights are being eliminated like crazy, and aircraft are moved into storage. It's interesting for me to see that it seems that the entire 752, 755-200 fleet has been grounded. I can't find them anywhere. They're flying wide bodies back and forth as usual across the continental US. So they're taking the planes that will not need to be serviced very soon, the brand new ones. So moving along to the next slide, you can see what's happened. This is American Airlines stock performance, and I'm just going to give a little bit of a spoiler alert here. My basic thesis consists of 2 assumptions. 1, the economy will return to normal or somewhat close to normal, and it will be normal within a year or 2. And number 2, that the airlines, if they need it, will get some kind of a bailout, and they will recover from this current disaster. So when you assume that, it means that you don't and if the assumptions are correct, you don't really need to lift the hood or whatever the equivalent is in an airplane and see how this company's working. If you know it's a solid company that has performed well in the past, it's really now, and I hate to say this because I generally don't believe this, but stock price is actually quite important right now, because all else being equal, ceteris paribus, things will return to normal. And we all know when things return to normal from the charts we've seen, stock price follows. So this is what happened to American, plummeted from 30 down to 10, and now it's bounced back to close to 15. On the next slide, you can see Delta, same deal, went from about 60 to 20 and is now close to 30. And if we skip along, we can see what happened to Southwest. Damage is not as bad, and it bounced back quite aggressively from close to 60 all the way down to 30 and almost got over 40, but now it's back in the high 30s. And finally, United, which dropped from 90. It had a more dramatic drop, not decidedly so, as we'll see in a second. Plummeted all the way down to 20, and is now back at just over 30. And if we keep moving, I think I put on this comes from Manifest Investing, which is sponsoring this presentation partially, I think. And this is the analysis that Ken showed earlier. So you can see the quality rating, which determines the quality of the company. United has question quality, but it has it's low. It's low double digits. But you can see the projected annual return, the figure on the right, as in. And if we skip along, we can just see that the other companies in the airline industry, at least the four I looked at, are pretty similar. American has a much lower quality, but it has a very nice projected annual return. Delta deservedly has much better quality, but the return is not as dramatic. And of course, the golden boy of the airline industry is Southwest, golden child, with much better quality. Always has been the case. I used to love this company years and years ago. It was very, very kind to me. It was a great company to study with the stock selection guide. Unfortunately, those days have gone. Still called a low-cost airline, but to some extent, its costs are often higher than the legacy carriers. Certainly, its pilots are among the highest paid in the industry for domestic pilots. So if we skip along to the next slide, I don't want to make this a movie, but I am. We have a once-in-a-lifetime exogenous shock to the system. That horrible phrase that economists would use if you're doing an MBA or undergrad in economics, you would hear exogenous shock to the system. No one expecting it to happen, of course, but we've had it happen twice, maybe 3 times if you count what happened in 2001. These shocks are great because they knock the price out of an otherwise good company, and as long as the company can weather the storm, and it looks like all the major airlines should, then things should get back to normal. And then the choice doesn't become which is the stronger company financially, etc., because they're all pretty close. You have to figure out who got walloped the most. And United got walloped the most because it has the biggest interest in international travel. It has a bigger network. It has more wide bodies sitting across oceans and down to Central and South America carrying passengers. So in the short term, at least, it is most impacted. And if we skip to the next slide, I'm drawing a blank of what I put on here. Oh yeah, what I did was I just showed the 52-week high and low, the close today, and those are dogs just giving their opinion on the selection. And then you can see American is 8.6% from its low, and it's got 100. If it jumps in price 189%, it'll reach its 52-week high. You can see all the numbers there. I prefer United because it seems to have a little bit more upside. Plus, I fly on them all the time. And I think that international travel may recover a little bit more quickly even than domestic travel. Southwest, of course, suffers the least of all the carriers, but it seems to me that United seems to have a little bit more upside. And I freely admit that I have a huge bias in favor of United, and particularly its original brand, which was Continental Airlines. I call United Continental Airlines, doing business as United. And if we move along, I think it's the very last slide. Could be wrong, I think it is. And all the airlines are impacted. United has more exposure to foreign travel, so that's perhaps why it's suffering a little bit more. Obviously, Southwest has very little exposure to foreign travel, overseas travel, so it's not suffering as badly. I think travel should be back to normal or very close to normal. And at that point, people will be basing the price of shares of the common stock of United Airlines holding on what's going to happen in the future. And that's why I think the stock price could recover even this year. Hope so, because it'll make me look good, he said selfishly. And share prices of airlines, it should bounce back. And also, just fly a flag from science here, if more money were spent on basic R&D, and particularly on that, we would be suffering a lot less right now. Just thought I'd fly that flag a little bit. And the hope is that after all this is over, and I know it sounds like, locking the barn after the horse is bolted, but putting more money into R&D is never wasted. So here endeth the lesson. Thank you, Mark.
Well, thank you, Hugh. As usual, very unusual. I do believe your dogs were calling out for Ryanair to be considered.
Yes. Yeah, I hate Ryanair. It's horrible. But by the way, just so you know, in answer to an earlier question, I would not regard United Airlines as a core holding. It's horribly cyclical. When that price falls, as you can see, it really falls.
Absolutely.
And when they in a recession, a real recession, not this full recession we have going now, but because this will bounce back for good reasons. But when there is a recession, you should see how low these share prices can go.
All right, well, thank you, Hugh. And let's go ahead and switch to one of the community's favorite stocks over the last couple of years, thanks to Nick Strategos and a couple of presentations here. But Si would like to double down or triple down on Five Below. Take it away, Si.
Mark, I'm going to squeeze in for just a second. Folks, there's lots of questions coming in. We're not ignoring your questions, but we're going to try to hold them until after our presentations. So please be patient with us. And Si, take it away.
All right, thank you. I'll try and be reasonably quick with this because, like Mark says, Nick's given a few presentations. This, I think, is about the fifth selection that it has been. I don't know if how many of those may include the audience as well. I guess Mark took me seriously when one of my slides that what I sent to Mark said the Chronicle tells it all because it's now the intro slide. This is the Chronicle. You can see a high quality company, a slight uptick in quality, in fact, over the last few months, and a huge uptick in potential return to the very highest that it's been over the last 4 years that you can see on the chart. And like Ken, I very much like buying companies where the return looks strong. I will also mention, begging Hugh's pardon, I'm a little bit trying to channel Hugh and perhaps Baron Rothschild for buying when blood is in the streets. This is a company that I'll go ahead and tell you, it's a retailer, their stores are closed. So that tells you something. They do still have an online presence, but their retail stores are closed nationwide. Next slide. So I started, as I often do, by checking the portfolio, kind of like you said. I like to buy something I already own. In this particular case, I don't own Five Below. I haven't followed it particularly closely. I know it through the roundtable. So I was looking at existing roundtable holdings in this case, and you can see that it came up pretty high among companies that I'm somewhat familiar with and was reasonably comfortable. I also considered booking a little bit, and perhaps Charles Schwab. Five Below has the highest potential return here, as well as the highest projected growth rate. Next slide. I went ahead, did a quick stock search. You could see the criteria. It was just twofold, quality of 90 and financial strength of 80. So I was looking for very high quality companies, ranked them by par. You see Five Below came in third. And if you want to know where I got the 90 quality and the 80 financial strength, I just arbitrarily downgraded Five Below to 90. Notice it's right at 199 quality. I said I'll go ahead and slip it to 90 to see what's out there, and then just rounded the 84 financial strength to 80. Next slide. Sector check. Ken referred to this on just the manifest stock page. It gives you the quick little snapshot of sector and industry by manifest rank. I went actually into the discretionary sector. Again, you see Five Below ranked by quality very high. There has the best return. Again, you see booking as a possible buy there as well. Next slide. The industry specialty retail ranking by quality, Five Below is the highest. And again, you see of those high quality companies, only 2 plus 5 below are above the sweets, or in the sweet spot or above. Actually, you can see on this chart, there are no stocks actually in the sweet spot, just Medifast 5 below and Etsy that are in the yellow. Next slide. And here is Chronicles Tell a Lot. Again, you see quality very strong and return very high, largely because of dropping in price. I think some China sourcing in influence may have been going on there. And then, of course, the last month, as I mentioned, the stores were closing and in fact now are closed. Next slide. For those of you who don't know what 5 Below is, it's a specialty retailer keying on the tween market. And as you may guess from the name of the company, everything is $5 or below. This is just the home page. Again, I showed this to give you a quick snapshot of what the company looks like and pictures itself. But notice at the top of the page, our stores are temporarily closed. Next slide. Here's from their investors presentation of a couple of months ago. They see themselves at that time as a unique investment opportunity, high growth retailer. They're growing units. We'll see a little bit of that in another slide in a little while as far as their store growth. New stores, they've been consistent performer, and as they grow larger, they expect their profitability to improve. Next slide. Just a quick chronology. The company started 18 years ago. Wayne, Pennsylvania, first store opened, and they closed out fiscal 2019 by opening 150 stores, totaling 936 states. Again, that's what I was mentioning about the aggressive store growth. That's about a 20%, little under 20% store growth in 2019. Of course, none of us know what the impact of store growth will be in 2020, given the current retail situation. Next slide. Here's what they say are their competitive differentiators: the tween and teen focus. They believe they're disciplined. They're fun. They try and be fun. That's what I wanted to show a little bit with the website and so forth. And good value they try and give you, and they keep stressing their highly experienced management team. Again, what matters when you're looking for a quality company? Management, management, management. Next slide. Here they are in 36 states, and again, the 900 stores, and you can see their net store growth over the last 8 years. They've been increasing, again, somewhere in that range of over 20%, a little bit back in 2012, and those early years now down to a little above 20% still in the last, right at about 20%. So they've been growing stores quite rapidly. Next slide. I wanted to reiterate again, Chronicles Tell a Lot, and seems like somehow one extra slipped in because I thought this was going to be my last slide, but I haven't shown my judgments. I guess I got those backwards when I sent them to Mark. Okay, or my memory. Here's the 4 judgments in the bottom line. Sales growth, I went ahead and said, okay, the value line and the consensus projections of 18.8, that was pre-COVID-19. Let's just assume a total shutdown for 2 or 3 months. That's going to chop somewhere potentially in the, let's see, 2 months would be about 16% of the growth off. And that's not 16 points, that's 16%. And of course, could be as much as 20 or so, depending on how much the shutdown is. And again, remember, it's not a total shutdown because they are continuing online sales. So I said, let's just take that projection and just say they go to zero growth for a couple of months, 15 going forward still seems to be very reasonable, even for 2020, much less 5 years out where you'll have 4 years of recovery. Net margin, I kept about at the 5-year average, which is a little below company and analyst projections to expand. They mentioned that earlier. I left shares the same. I'm not sure why Value Line's shares went up. The company has been pretty steady on shares, slightly declining. Perhaps Value Line knows something I don't, but it's not a significant difference, as you can see there. And I came in right at the consensus PE forecast, and you see projected return by my judgments between 21 and 22%. I think this is a solid retail company. Yes, it's trashed right now, but although it's not going to get necessarily the same level of bailout that Hugh was talking about the airlines, it is very likely to survive. And if so, it should rebound quite well. And I think we can enjoy this depressed stock price and make some money on Five Below.
Thank you, Si. Good stuff. All right, Kim, go ahead and crank us through Dow.
Well, full disclosure, I own Dow. Like Hugh and Si, I like looking at my portfolio and say, oh, I've got some cash. What has fallen in the toilet? And this was Dow. I presented Dow, and it was a recent spinoff. It spun off last year and started off at a price of about $60. And a week and a half ago, when the market was in the tank, it got down to a low of $21.95. Now, in March, the CFO did a presentation through JP Morgan, and that's where these slides came from. Next slide. Now, they have said that their priority is to be profitable, and the big part I like here is this disciplined capital allocation. I've learned that in my portfolio, all the stocks in my portfolio, I want to have a return on invested capital of at least 10%, hopefully 12. I like it when they have a low cost operating model, and they want to be the best owner of it. So they were giving us a presentation on how are these priorities following through from their investor day that they had presented in 2018 prior to the spinoff. Next slide. This is where they had showed how they have done. In their Investors Day 2018, they said they wanted to have profitable growth, enhance customer centricity, and what they've done to date, they have $3 billion of revenue through a new commerce e-portal. They've also got $250 million of EBITDA in 2019. They recognized they had some bottlenecks in their distribution in silicones, and so they've got that cleared up. They said they want to have disciplined capital allocation, a strong credit profile, and a focus on cash. I learned this saying that earnings don't pay the bills, cash does. So those companies, when they do their presentations and talk about how they want to give cash back to shareholders and have a very strict capital allocation plan, I love it. So this company has reduced their gross debt by greater than $3 billion last year. And the next maturity of a bond that they have due is to the second quarter of 2023. They have $2 billion in CapEx last year, and this year they expect to have 1.5 to 1.75, so they're reducing those costs. They have $5.7 billion of cash funds from operations in 2019, but that was an increase of $2.6 billion. They're converting more of the bottom line into cash, greater than 90%. So the bottom line is when you recognize those cash comes down to the bottom line after they pay their bills, that's more for money for the company to grow, and that's more for them to be able to pay us in dividends. And as a shareholder, when we have a recessionary market that we could be going to, or it's a fluke, I do like when I can have my dividends and reinvest them at a lower price. Well, Dow pays out $2.80 a share in dividends. So they sent back to us as shareholders $2.6 billion. They've cut a lot of costs and of 160 million in 2019, and they're on track for another 140 million in 2020. They like to benchmark themselves against other within the industries, and the following slides will show us what more they've been doing on that. Next slide. They have significant free cash potential, and near-term actions are in focus. So they have approximately 1 billion of free cash flow upside potential in what they can do going forward. There's a tax paid on a pre-2012 judgment that they're hoping for. They've reached a settlement on that judgment on the Nova litigation, and they've got other cash conversion improvements on focus of working capital efficiencies and the tax structure. One of the things that they say is that they want to be sure and have a very safe dividend. So they're reducing their expenditures, reducing their debt level. They're buying back a few shares, all to make sure they can maintain that dividend. And currently the dividend is like equal to like 9.8% of a yield, which is very, they don't want that. They expect the stock price to go up. So, but right now it's great for us as shareholders. Next slide. Okay, in their packaging and specialty plastics area, look at where Dow is on each of these graphs. They're operating, EBITDA growth trailing 12 months is at the top of where they want to be. In each case, they've got the highest efficiency in all that, in those areas. So they're removing those costs, increasing productivity gains, and making that cash conversion cycle much more efficient, and that's more cash to our bottom line. Next slide. In the industrial intermediates and infrastructure area, they're doing the exact same thing. They're the top global producer of key raw materials, and their asset expansions have been successful. They want to focus on more cost removal to get more productivity gains. They're tilting the industrial solutions mix toward the highest returns on the ethanol. When they spun off this company, they did it so that they had the most efficient areas and the most highest profit margins were spun off into Dow. So I'm not going to complain with high profit margins. Next slide. Their performance materials and coatings division, you can see what their strengths are on the left and over on the right on how they're planning on focusing going forward to even make those better. And I think the biggest thing is, if you'll notice in each slide, they're wanting to further get productivity gains so that they can be much more efficient. So they've got NOR business-to-business digital model for coatings. The industrial coatings portfolio is increasing. They're hitting it on every signal. Now, if you look at the SSG, I'll be the first to admit the revenues are down, earnings are down. But guess what? They're much more efficient in what they're doing, and more money is falling to the bottom line to us as investors. Next slide. And here you can see that of what their free cash conversion reconciliation is. Now look at each division here, Mark, if you can circle that. In 2017, in the first column, they had 56% conversion for free cash flow. Now it's 75%. Yeah, 56 to 75. Now we had 83 to 73, so they're having to work on that area. And then 72, 74. As they get more efficient, more free cash falls to the bottom line, and that's good. Next slide. I can't imagine how I found this, but this is the April 3rd value line. Today the stock price closed at $29.21 and the RSI was 41.45. Now you can see that when the stock price hit its low at like $22, look how much it is up from that. Now the latest value line, one of the things I always like to look at is the projections box. And you can see that the annual total return for me, I won't look at a stock unless the low annual return is at least 10%. Well, what you've got here is 30%. Also look at that PE, it's only 8.5. And look at the bottom circle on the far right-hand side. They're expecting the PE ratio to get up to 13. You have PE expansion. What happens with PE expansion? Stock price goes up. In each case of these, you can see where their cash flow per share and how they're getting those efficiencies. It's gone from 7.50 to 11.45. Earnings should be going up from 353 to 575. They're anticipating dividends could go up in 5 years to $3.60 from $2.80. Nothing. I love it. Next slide. Rest of the value line shows where these operating margins from 14% to 16.5. And there's that return on total capital of going up. Their goal is 13%, and that's where it is going out 5 years. Now, when you have the Nicholson triple play, you want to have a stock price which is depressed. You've got a PE which is depressed, and you want it to be able to expand. And you've got operating margins that are consistent or rising. You've got all three of these here. So here you have a triple play. Next slide. Okay, this company, being in the plastic industry, it's getting squeezed because energy prices are down. And then you've got the virus going down. They have a plant in China and they've had to shut that down for a while, and they say it's starting to come back. But because this stock is a recent spinoff, the quality ranking on Manifest is so low. That's why it is. This company has core strengths of the feedstock flexibility, a lean cost structure, and leading positions in consumer-driven end markets. Low risk, high return investments ought to pay off down the road, and efforts to control costs to support that profitability. Looking further out, the issue offers attractive recovery potential for the mid-decade. On top of that, the equity features a healthy dividend yield. If you buy it, you sit, let the dividend go in, reinvest it, and the best part of all, that company's financial strength is an A+. Next slide. Now, I get a little greedy when you have a market correction like we've had. I like to know, are the insiders buying the stock? I looked this up on the SEC website, and these are all the buys I found within the last month. The director, Jeff Fetting, who's the former CEO for Whirlpool, bought stock 4 different times, at $38.13 and at $24.62. The CEO, Jim Fettering, he bought at $24.61. That's $500,000 there, as well as Wesley Bush, who's he's a chairman of Northrop Grumman. He's one of the directors, independent directors on the board. He spent $500,000. So you've got insiders who are buying the stock. I like that. That means they also feel it's undervalued, because the only reason insiders buy is because they think it's undervalued. insiders can sell for many different reasons. They can have a disciplined plan that every quarter they sell some. So I don't really look at the sales as much as I look at the buys. Next slide. Now, everyone might ask you, is the dividend safe? Well, they've done more and more productivity to be able to be more efficient. And there was a CNBC presentation with the CEO on Kramer Mad Money, and is that dividend safe? And as in that transcript of the presentation that was done March 10th, you can get that off the website. They paid down $3 billion in debt, and they have more than $2 billion in cash. They recognize it's an artificially high dividend yield, and they've been in the best financial position they've ever been in because they're ready to go into a down cycle because they recognize we've had a 10 and 11 year bull run. And one thing a lot of people may not recognize is they got their first Euro bond, and what they did is that coupon was only 1%, so they paid down their existing debt. So as you say, they have no further debt due until 2022. Next slide. This is the most interesting thing I've seen. I don't know how many of you recognize, I've been saying always look at your 14A filings, which is the proxy. You'd love to see what the insiders have got skin in the game and how do they make money. Well, here it is, the CEO of the company. He was given grants of options in February and April of last year. These all vest in 3 years, and notice the circle in red at what price the stock can get exercised at. $54.89. I hazard a guess, within 3 years, the stock price will at least be $54.89. Next slide. Here is the manifest. They feel that the quality ranking is 59. That's part of the thing because it is a stock that's only been around about 11 months. And the par is 27%. And this is the stock I'm presenting. And I think that's my last slide. Oh, no. For the 1 year, this was from E-Trade, the 1 year price target by E-Trade is $44.25. So that's a 51% gain from where it is currently.
Very cool.
So I hope you guys will consider Dow as a stock.
All right, we'll go ahead and throw another log on the fire.
Thank you.
All right, Ken, we're running a little bit late, but I suspect our audience is sheltered in place anyhow. You think there's any harm in finishing out the presentation, or do you want to skip mine?
No, Mark, why don't you go ahead real quick and do yours too?
Okay, as you know, I'm usually pretty quick about these. I just want to basically focus in on a fairly simple concept. You know, right now, we refer to the Wall Street analysts as rhinos. I don't need to explain why, but the rhinos are circled and they are, you know, basically trying to figure out what they're doing, what, you know, the opinions that they spew move markets. And just this notion of the pendulum swinging both ways, and they can swing it, you know, to the downside, to the upside. And one of the ways that we watch that is a momentum indicator. You can learn more about it on stockcharts.com, the relative strength index. But I love to find companies very much like Hugh's methodology, only this is a technical analysis approach to it, of finding companies that have really been crushed down, like you just heard about Dow, and into an oversold territory where a relative strength index is less than 30. Okay. Manifest Investing members will recognize that we have been putting out lists of companies that are hugely oversold here in the last few weeks. And I just want to give you a quick example, maybe to whet your appetite. This whole notion of what if you take a stock that you wouldn't mind holding, like a core holding perhaps even, for the next 5, 10, 15 years, and the opportunity to acquire it when it's being absolutely pummeled. And in this case, here are 5 stocks from, I believe this was a Friday, March 20th. And then just 5 days later, I mean, look at Chef's Warehouse, the fourth one on the list here. It went from a deeply oversold condition. The stock price went from 1171, or excuse me, it went from 554 to 1171 in 5 days. So over 100% stock price appreciation in 5 days. That's the type of unusual moment that we find ourselves in. Ken confessed that he bought one of the cruise line companies under similar conditions. You see Royal Cruise Lines there going up 77%. So again, with this notion of what if we screen for very high quality companies and companies that are in this position of being absolutely pummeled by the rhino pendulum. And here's a fairly short list. It's actually got some names that I would find a little bit challenging to pursue. I do find it interesting there's a couple of underwear companies on this list. But the one at the very top, I'm not going to go crazy. I'm just going to stick with the one at the top, DMC Global. The ticker symbol is BOOM. Very high return on owner's capital. The stock price is trading within 14% of its 52-week low. Value line thinks the return is in the high 20s. Morningstar and the analyst consensus say that it's priced at a discount of 50% to its fair value. I find all of those things compelling. Here's a look at the price chart to show how much it's been pummeled. It literally has imploded from a price somewhere around 50 down to 20. And again, the relative strength index as shown on stock charts right here, bottoming out below 30 and starting to climb out of the hole. So we're still down near that point in time. This is a nostalgic moment. Some of you probably remember the very first groundhog contest was won by Steve Parham and his dog Bo on the front porch. And Bo liked dynamic materials back then. That was his top performer from 12 years ago. Some pretty interesting names on that list, including one of my favorite all-time selections, Navtech. Another thing that kind of pushes me over the edge with this one is Brown Capital Small Company Mutual Fund. This is a holding of that particular mutual fund since September 2007. They've held it all that time. Wow. Here's a look at how that stock has done since that point in time. And again, the point to be made here is thanks to Hugh's exogenous moment in the stock market, it's priced where it was 12 years ago. So, wow. Here's a quick look at the company. You can see that it's not a classic up straight and parallel, but it is a company that is in the construction business. It's exposed to the energy industry, oil and gas field equipment. So it's going to have some bumps. But over the long run, that's a 7% growth rate. You can see that the profitability of the company is not steady. It is quite bumpy, as you would have with a company like this. But it would be reasonable to expect something in that 8 or 10% range, out over the long term. The PE ratio, again, bumpy for a company like this, but again, a high teens PE ratio. The growth rate of 7%, projected net margin of 10%, and a PE ratio of about 18, which all reconciles pretty well with the pictures that you're seeing here. Gives you a company in the mid-20s for our projected return. And you can see some of the other numbers there. So lots of good stuff. All you got to believe is that, like you said, the other side of this chasm is basically a situation where we're going to need more natural gas and oil. And even if we were to snap our fingers and not need as much in the United States, the world is still going to be out there needing energy supply. And these guys are one of the leaders in figuring out how to supply some specialized equipment and materials to serve this market. And so worldwide, the demand's going to be there. Domestically, it's going to be there when we come out the other side. So I'm going to go ahead and take a bit of a flyer, sticking with the theme of going after companies that have been kind of crushed here lately, and add BOOM in honor of Steve's dog Bo to the tracking portfolio tonight. We'll cover more of that probably next Monday or Tuesday when we decide that we're going to have to get together with Ken. All right, Ken, I think we're ready for the poll.
And you should be seeing the poll right now. Take just a moment, if you would, folks, and vote for the company that you'd like to add a share to the portfolio. Every month, not only do we add $1,000 for each of the stocks presented, but we add an extra $1,000 for the audience first choice. So take a moment and pick the stock you think you'd like to add to the portfolio. We don't know how you're voting, so just go in there and hit one with your mouse, or if you're on a touch screen, I think you can touch the screen.
We can get in there and figure that out, though, can we? For
Yeah.
purposes and all that.
Oh, that's right. Scare them all away, Mark. Okay.
Everybody stop voting all of a sudden?
I'm going to kind of count backwards for just a moment here. We're up to about 85% voting. So come on, take a stab at it, folks. It doesn't cost anything to vote. And the more of you that vote, the better chance we get of seeing what you're thinking. Okay, I'm going to close the poll. And I'm going to share the results. And we're going to add an extra $1,000 in Dow. And you can see for yourself the percentages that each of the stocks got. So I'll leave that up there for just a moment. And we'll hide that. And Mark, if you want to go on to the next slide, and then we can maybe answer a few questions, okay?
Yep, just real quickly, obviously our future engagements are a work in progress. Ken and I had several appearances here that scheduled over the next couple of months that are now at least postponed for a few months. We are going to have our webcast, and I couldn't remember whether it was Monday or Tuesday, Ken, but I had.
It is. I checked the calendar, Mark. It is Monday. I was mistaken. It is April 6th.
So we won't be doing Turnout Tuesday. It'll be Manic Monday for the stock market. I'm fine with that. And I just wanted to point out that we do have various webcasts in development. I've even thought about perhaps getting together on Saturday morning to go into some of the stuff in a little bit more detail. So we might do that, and there will be other opportunities. Ken, are you still scheduled for South Carolina in June?
At the moment, I'm scheduled for it, Mark. But I think that any dates up through June are kind of sketchy right now. So we'll just have to wait and see how it goes. I just found out that where my sister-in-law lives in Virginia, they've shut everything down until June 1st that she's supposed to shelter in place. So Natalie says June 10th, not June 1st, June 10th.
Yeah.
So
there's
we'll just have to play it by ear. Yeah.
There's stories of people that have properties on the ocean in North Carolina that can't even get to their, their vacation residences at all. They're being stopped by from entering the area. So yeah, it's a time.
There's a county in southeast Georgia that will not even let you pull off the interstate for any purpose if you are not a local resident.
Wow.
Yeah, so
no gas, no food, no nothing.
So stay tuned, everybody, I guess is the message, and we'll keep you posted as best we can, but we will be providing a few more opportunities for this type of stuff. Ken and I want to talk about PayPal one of these days. So we'll be doing
absolutely, yeah. So Mark, why don't you close the recording down, and then we'll keep talking about questions here after we close the recording, okay, folks?
Okay, let's go ahead and do that. We are running.
Yep. As